But overall, yes, for a few reasons. Fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
That was Jay Powell there giving his outlook for the US economy after the Fed delivered its third consecutive rate cut. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Good morning. We are counting down to the open of markets in mainland China and here in Hong Kong. Let's get to your top stories today. As you can see, markets are doing well. The rate cut, of course, and Powell's economic optimism lifting sentiment across these markets. Equities gaining after U.S. stocks posting their biggest jump on a Fed decision day since March.
The dollar, meanwhile, suffering its worst day in nearly 3 months. That's as the Fed chair highlights labour market risks while downplaying inflation concerns.
Also ahead, we're looking at Oracle and the effect it's having across markets here. The stock plunging in after-hours trade after the company reporting a jump in spending on AI data centers while cloud sales disappoint.
And China Vanke's shares and bonds in focus after rallying on signs of progress in its debt talks.
Good morning. Welcome to the program. Risk appetite is not wanting, as you can see on your screen, half of 1%. We should be getting a further boost in the next few minutes with Taiwan coming online. It's also a weak U.S. dollar story, as highlighted there by the Bloomberg Asia Dollar Index. We're better by about a tenth of 1% stronger. And that, we're looking at a fix, obviously, going into the session today. Gold is seeing some gains. Silver, not on your screens. Just take my word for it. Also seeing a fresh record today. Right, a glance at the yield curve following the rally that we had there. 2s and 10s on the spread. 2s and 30s also on the spread. Slightly flatter today, although at about 60 basis points, that should be putting us very near multi-year highs on the 2s. And also the 10s, more on what it means actually in terms of the bond buying, bill buying rather, as far as that's concerned. $40 billion a month, does that ensure liquidity? Does it keep the very, very short end anchored? We mentioned Taiwan, TSMC is coming online. You have, of course, the Oracle effect, and that's playing out across some, not all, and we'll get into the weeds of this in a moment there. And, of course, the approach to the open today, it's looking like we will be getting a rally set to join what we're seeing across the region. We bounced off to the upside, the 200-day moving average on the Hang Seng China Index. Interesting, we'll be looking at southbound flows today following net selling, which is a rarity this year. We had that yesterday, so we'll see whether that bounces back today. A lot of trading debuts to watch. You have Jindong Industrials, plus, of course, you have a couple of ETFs, including, if KWEB sounds familiar, that is now available here in Hong Kong. Not as if that wasn't available to you guys in Hong Kong, but yep, we'll get into that in a moment. 705.89. Wow, okay, we've taken out the 706 handle there on dollar China, Bell.
And I think, as you're saying, that really the stories around the Fed today, and yes, we were expecting that cut very much, but it's really that question of the dissenters, not just the ones that were actually on the voting committee, but the other people that were also voicing their discontent through other channels. But let's get the latest on this. Take a listen.
It's a close call. We have to make decisions. And we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once.
And if you look at the outlook, so the central bank's outlook itself, just one rate cut going into 2012, one rate cut specifically in 2026. And current, our Federal Reserve and economy reporter joining us right now out of Washington. And how do we need to be looking at, to the point Bell was making, the dissents, formal or otherwise, the discrepancy in what the dots, Fed Fund futures, economists are saying in terms of the outlook for next year? How mixed is the picture currently?
It's pretty mixed, David. You can see how much division there is on the whole committee now. As you mentioned, we had 3 dissents today. That's the most since 2019. And then, of course, you look at the projections, the dot plots for where people think interest rates might be over the next year and the year after that. Clearly, again, very divided views on where policy is headed there. And of course, you know, you heard Chair Powell make the point there in those remarks at how close of a call this was. A lot of Fed watchers are talking about these so-called silent dissents. That's people who, even though they probably were concerned about inflation, not necessarily super hot about the idea of cutting rates again, went along with it on this occasion at least. We didn't get very firm signals about where we go from here, but certainly a lot of people are seizing on the fact that Chair Powell mentioned they're somewhat closer to neutral territory, maybe in the high end of neutral territory, and that's prompting some people to think that maybe the Fed are going to be on hold in at least early next year.
How do you think then it complicates the story for the Fed, the next Fed chair? Because Jay Powell, of course, ends his term next year. You've got President Trump possibly kicking off formal interviews this week. When you've got that level of dissent, it's going to be quite challenging, it seems, for someone to bring people into line and to get that quorum of opinions.
It's getting very complicated. The economy, the policy story itself is confusing because we haven't had data for so many months now, Annabelle, as you know well. We're going to get a flood of data over the coming weeks and months, which might help clear up the picture. But Fed Chair Powell himself today made the point that even that data will take a while to iron out and to give a clean read on where things are at. And then overlapping that confusing economic story, as you mentioned, we now have this political backdrop in terms of Powell's intrigue. Who might be appointed as Fed chair? What might that Fed chair be pressured to do by the president in the White House? How might that Fed chair steer consensus or steer the debate on the committee? Will he be able to pull enough votes together to either lower rates, presumably at least early in the term? But I think a lot of this, Anne-Marie, will be settled by the economy. Remember, right here, right now, the Fed are saying they're cutting because the labour market is weak. If in a few months from now they turn out to be vindicated, inflation continues to head back towards the target, and the labour market is indeed weak, then it looks like a good call, and it certainly would make it easier for the next Fed chair to come in and carry on saying we have scope to cut here. The real complication, the real tension will come if in 4 or 5 months from now, the labour market is weak or weakening, but inflation is still not just above target, but well above target and threatening to go in the wrong direction. I think that's where you'll really start to see the rubber meet the road in this Fed debate.
Well, speaking of fueling that Fed debate, just to borrow the concept there of lower rates, the folks at Bloomberg Economics and have not just one, not just two, not just three, but they have 4 rate cuts priced in 2026. What's the case they're making there? What's the call?
The case there is a weaker labour market, and that's where the whole dovish case lies, that the jobs market is weaker than we understand right now. Private sector surveys and state-level gauges are pointing towards the fact that jobs are being lost and it's harder to find work. And we're also getting some big headline announcements now from brand name companies who are either announcing layoffs or actually making cuts. Now, it's difficult to contextualize just how much of a hit all of this is to the labour market because, as I say, we haven't had that official sector data from the BLS for several months now. And of course, economists will argue about the flaws in that data, but nonetheless, it at least would have been capturing the trend and telling you where the jobs market is. It's hard to get a true read on that. And when you also consider, by the way, the big growth upgrade by the Fed in its forecast today, it tells you we're heading into a pretty strong economy next year, which is why the whole dovish case rests on the labour market. And as I say, we'll get a big data dump next week on jobs and inflation, but it's going to take a couple of months, if not more months after that, to really get a clean read on just what exactly is going on with jobs and inflation here.
And great to have your perspective this morning. That was our Bloomberg Federal Reserve and economy reporter, Enda Karan there. And just in the last few moments as well, we've actually had some breaking lines crossing the terminal here, but relating to Mexico. This is anticipated, but to say that they have approved wide-ranging tariffs of up to 50% on China. So lawmakers giving their final approval just in the last few minutes here, but new tariffs on Asian imports. So broadly coming into line really with US efforts to tighten trade barriers against China. These new levies are slated to take effect next year, and they are set to hit a wide range of products from clothing, metals, auto parts as well. So the finance ministry in Mexico estimating that these new duties are going to raise nearly 50 billion pesos in extra revenue next year. 52 billion pesos, that's around $2.8 billion in import revenue that's anticipated for 2026.
Okay, I'm looking at market reaction, or the lack of it. Nothing much in the currency, Chinese currency specifically, dollar peso. It's early. It can't be too liquid at this point in time. But yeah, we'll see what this looks like. Equity futures are not really also doing anything on this specific news, although it is, of course, a rally we're seeing here today. There's the Fed story. There's also the Oracle story, of course, and the nuance there. Down 12% in after-hours trade. Some of the big names tied maybe to that story are seeing some pressure, not joining the rally here today. Belle, you were covering this earlier. What can you tell us about this one?
What I can tell you is that there's a lot of concern around the capex in particular. And this is really quite extraordinary numbers, actually, because in the latest periods, this is the fiscal second quarter, the capex rose to $12 billion. In the period prior, it was $8.5 billion. So already you've increased from 8.5 from the fiscal first to the fiscal second quarter at 12 billion. What is also quite exceptional is that Wall Street analysts had been expecting it to track down to $8.25 billion. So it's come in much higher than had been anticipated. And the concern here is that you're not really seeing enough ROI, because when you look at the spending or the revenue from the cloud division, for instance, that came in at around $8 billion. Infrastructure business as well, around $4 billion. But mostly what's important here is that that was also shy of analyst estimates. So lots of capex. Again, not seeing that ROI, and you've got that reaction in Oracle, but also SoftBank.
Yeah, I mean, we're down 5% on SoftBank itself. Yeah, so let's tie those two things together for our viewers in terms of the market's reactions. There's the Fed story and there's also the Oracle story. Joining us here in Sept, Winnie Su, our Asia equities reporter, to talk us through this. Why don't we start with the Fed and some of the commentary you've heard so far from the people you've spoken to?
Yeah, exactly. It has been quite a mixed picture so far this morning. We talked to people. Some say that it's you can take it both ways, whether it be a little hawkish or a little dovish, depending on which part of the commentaries you take. And on the slightly hawkish side, it's just, the fact that they might see just one cut next year instead of what some people are expecting for two. However, the important thing here is that it is a combination of expecting a stronger growth when it comes to the economy, but also softer inflation outlook. So that combination actually sets up the markets quite well. It's what we actually want to see in terms of kind of that gains that we're seeing in Asian markets today. So it's supporting Asian stocks in both ways. For exporters, it's good because if you're going to have a good economic outlook from the U.S. and for the domestic oriented stocks, it's also good if you expect these Asia central banks to have that room to further cut rates on their side as well. So it kind of supports different sectors in different ways. And from the currency perspective, yes, you have a bit of a weaker dollar, and hence we're seeing a bit of a strength when it comes to the Asia EM currencies. But like you said, it seems like the kind of gains that we're seeing in Asia is not a whole lot, right? Yeah. Because there is that concern around the AI front that Bill was just talking about.
But it's interesting when you take a look at how AI-linked names are doing so far in Asia today. Actually, they're holding pretty steady. You're not seeing that magnitude of losses, with the exception of SoftBank, which obviously is quite a intrinsic story in the sense they're so linked to OpenAI and to Oracle. So why do you think it's not translating as well?
Yeah, so that was actually what we've been asking as well, if there is a spillover effect from this Oracle story or not. But so far, because actually, there are two sides of analysts. We do hear from the more Japan-focused analysts saying that it basically is the worst of both stories, whether it's the revenue side and also the capex side not looking great. But because it's so much linked to OpenAI, we are most likely to see the effects confined to just the OpenAI-related names, especially SoftBank and especially the OpenAI-related stocks. However, when we talk to kind of just the broader the strategists and fund managers who look at Asia broadly, they are actually quite concerned about if this means, like you said, that we are not going to see as much revenue translation from just how much investment investment is putting into the big investments. However, just because we are seeing a bit of that tailwind from the Fed today, and hence the effect on the broader tech stocks today has been a bit muted.
Mm-hmm. Winnie, thanks very much.
Fantastic.
That was our Asia Equities reporter, Winnie Xu there. And we're actually going to get more on today's top themes. Of course, that's AI, and that's also the Fed story as well, most importantly. But Eastspring Investments is joining us next, and why they actually think that tech trade and AI specifically is the key risk to watch. We're counting down as well to the open of trade in Shanghai, Shenzhen, Hong Kong. You're watching the China show, and futures are looking like we're going to see some modest upside at the open. More ahead. This is Bloomberg.
The fixing of today, you're just in time here, 706, 86 against the US dollar. On top of already the stronger Asian FX complex, you have this, and of course, that's now driving dollar China even lower. We're now talking 705.50, let's call it flat, along these lines here.
Yeah, and of course, part of that is really the dollar story as well, and what we've seen on the reaction to the Fed. But let's get more on that now, bringing Christina Woon. She's portfolio manager at Eastspring Investments, joining us. So, Christina, we can start with the Fed and your reaction to the decision.
Yeah, I think the Fed cut rates as expected, and that was a fairly consensus view as well. I would say that what that reiterates for me is that we will see into 2026 traditional opportunities or avenues for income tail off a little. And then when we think about how the market's actually done so well this year as well, perhaps a narrowing of the opportunity set for alpha as well. So I do think that going into next year, where we are right now, we probably will have to be even more selective in trying to drive both income as alpha for equity investors.
Okay, well, I was going to ask you then what this means for a trade that's been very, very popular, Christina. David here, by the way, we talked at length about this already with you too. The AI trade and the mega cap play in the U.S. And we've seen an internal rotation within some of those big names in the U.S. of late. How has that affected how you look at your portfolio, or has it affected you at all?
Yeah, definitely. I mean, I would say that just given how everything has shaped up over the year, or actually over the past few months within the AI trade, that strong rally means that it is definitely a key risk that we have to watch, even out here in Asia. We've got diversified supply chains here, but it doesn't mean that it's something that we should be complacent about. So I do think it's something that, I've been taking a bit of profit into the rally. But having said that, I do remain constructive on the trade. I was in Seoul just last week speaking to some of the big memory makers, and the consistent message that we've been getting is that supply into next year remains very tight. So that does have positive support for demand and supply within certain spaces. So I can find some comfort by focusing on where the bottlenecks are within this trade.
And so how do those continue to perform? I think obviously the big theme we're watching is Oracle, for instance, and in their latest numbers we see quite a significant capex spend, a lot more than Wall Street had been expecting, but still that ROI isn't there quite yet either, or at the level that's been anticipated. How long is this sort of going to also sustain? Of course, they've got the demand for memory from the likes of Samsung or SK Hynix, but when does that also start to reach a tipping point, do you think?
Yeah, I think the worry that we have when we see all these big capex numbers, and I think we've seen that expressed in the market as well, is on the funding side. But again, if we look at cash flows, and if we do see, or we do have the expectation that cash flows should pick up a little alongside or keep pace versus where they are right now, then there should be some support for that overall rhetoric. I would say, though, going back to my point earlier, that's where we really do have to focus on where the bottlenecks are, because that's where that gives you more visibility and comfort in playing this trade. The worry, of course, that people have in mind is with all of these big numbers that we're seeing, is there the risk of double booking anywhere? I think we have to be cognizant of the fact that risk will always be there. So again, to solve that, you have to focus on where the bottlenecks are.
And risking asking you the obvious, where are those bottlenecks? And you just mentioned that you've recently come from a trip to Korea. Is it in that market? Because that market's also done exceptionally well, and I wonder how you pair that with the price right now.
No, I think that's absolutely right. So Korea's been such a strong market this year and it's driven so much by tech. I would say, though, that the memory players are just given what I've heard from them about the complete lack of clean room facilities into next year. And, you know, capacity doesn't just come in overnight. You can't snap your fingers and magic up capacity. So we're still looking at that situation remaining tight at least into next year as well. So I do think that within the tech trade, the memory players do stand out quite well. The difficulty with that, though, is just given how we balance that out with where sentiment is, which is why I do think that for prudence sake, taking some profit into the rally still remains my stance at this point. And then elsewhere in Korea, I wouldn't forget that there are other themes that are playing there as well. I'm still finding ideas. So, for example, just last week or earlier this week, we saw the dividend tax reform come around as well. So that does have implications for how companies will be thinking about their shareholder return policies in the coming months. So that could be a potential opportunity for income funds too.
We've spoken with a few analysts that are saying that in light of these concerns around the AI bubble, essentially, they're thinking maybe India could present a good diversification opportunity for 2026. Are you in that camp as well?
I am. I mean, I would be in agreement with that. And, you know, India has quite a number of things going for them at this point. You know, domestically, they had the RBI cut last week. Inflation does remain benign at this point, which does benefit household spending. Going into next year, if we do see a finalization of any trade deal with the US, that could also be positive for sentiment. So a number of things that are lining up possibly into next year. And then, as you mentioned as well, just given how many of the companies or listed companies in India aren't as driven by the AI trade as you would see in the rest of the world, it does present as a pretty good AI hedge in the current times from a portfolio perspective. So I do think for diversification reasons, India is actually a good allocation to have at this time.
Christina, fantastic. Thank you. Christina Woon there in Singapore out of Eastspring Investments. Going into the open today, we're higher 0.7 of 1% on the Hang Seng Index. One thing that is down, though, this trading day, with Jingdong Industrials down about 8% to $13. The opening about 6 minutes away. This is The China Show.
Few minutes away from the open this morning, taking a look at some of the movers. China Vanke is in focus because we had the very much anticipated bondholder meeting taking place, and actually we saw a rally in equity and credit markets rather off the back. So discussion of maybe some sweetened terms for an extension of that debt plan. Jingdong Industries as well. We've got this stock sliding here at the start of trade. It is an IPO for this company, or start of trading, a trading debut rather. But we are just going to be watching that one at the open. They've raised $383 million in that. More ahead. This is Bloomberg.
Welcome back. You're watching The China Show. We're counting down to the open of markets. Let me do a literal countdown for you along the Fed theme. 4, 3, 2, 1. 4 is the number of cuts Bloomberg Economics think the Fed will deliver next year. 3 is the number of dissenters on the Fed. 2 is the number of cuts priced when you look at Fed Fund futures. 1 is the number of cuts priced when you look at the dot plot. That's your countdown to the open. 20 seconds away, we are looking at gains across the board in risk assets, weaker dollar, equities moving to the upside today.
That was a really perfect introduction there, Dave.
Was it?
Yes.
Thank you.
All right. Yeah, pat on the back.
Yeah.
All right. Coming into the market open this morning, I think, you've got those broader macro factors, and it's certainly that Fed decision. And yes, you got that cut, but it's also a lot of dissenters that you're seeing as well on the committee. So with Kevin Hassett firming up to be the next Fed chair, it is a big question of how he's going to really be able to manage the troops essentially going into 2026 and reach a decision on where rates should actually end up going. But we do see markets here at the start of the day moving higher. It has been been a fairly strong Thursday afternoon, actually, that maybe is translating across this morning. But some of the sectors, for instance, we've been watching in particular, well, there was a surge in retail stocks, for instance, yesterday. You can still see Kweicha Motai, for instance, moving to the upside. My dear is just kind of flat. But we did see Beijing calling for prioritising the retail industry as a key driver to boosting domestic demand. What else we're watching as well is the property sector today, because, again, we had the China Vanke meeting coming in yesterday, maybe some better terms around that debt extension plan. And we did also maybe see these hopes maybe we get a little bit more state support. And so that lifted or boosted property stocks yesterday as well. But we will shift to Hong Kong now, and you can see just Cambricon Technologies there, but down 1%. There has been some reporting. Again, we're continuing to get details on maybe there's names, the likes of Alibaba, for instance, ByteDance, this is Reuters reporting, but saying that they could actually be interested in buying those H200 chips from NVIDIA, and they're already awaiting guidance or clearance from Chinese government officials. So, of course, has a bearing on names like Cambricon, but also in the session today, you're seeing tech moving higher. It's been a big move, though, of course, for Oracle, and that is one of the key players we're watching today. Any sort of spillover effects, given Oracle just tracking very high on its capex, but not seeing a huge amount of ROI. Let's also shift and take a look at some of the pharma stocks this morning, because we actually do see China saying it's going to be accelerating the approval of overseas drugs that are needed urgently. We are seeing that having certainly a bearing today, because a lot of these local pharma names are under pressure, but they are looking, as I said, speeding up the approval of overseas medicines that are urgently needed in clinic use, and especially those for rare diseases or children. And as well, you've got this IPO taking place this morning. So this is a unit of JD.com, but it is under pressure so far. It was an IPO that raised more than $380 million.
Yeah, today. The gray market was mixed going into today, mostly lower. So it's unsurprising we see some pressure, but I'm quite surprised, actually, that's quite substantial. Down about 7%. Right. For some final thoughts going into the new year, still with us, Christina Woon, portfolio manager at Eastspring Investments. Christina, thanks for sticking around. Let's maybe wrap things up with China. Market's done well. We started out the year, foreign investors were massively underweight, maybe less so at this point in time. What do you think drives the equity market next year?
Sure. As you've mentioned, China's been quite strong this year. It's one of the stronger performing markets as well. And I would say that actually where we are right now at the end of the year and going into next year, things are looking, I'm a bit cautiously optimistic, I would say. And the reason why I raise that is because similar to many other markets, we've had some parts of China rallying quite strongly. The tech names in China have done well, or the internet names in China have done well. You've had some industrials also hold up pretty well this year. But is the capital recycling trade or rotation into some of the laggards this year as clear? I'm not as sure. So, for example, within consumer, we have had some headlines around support potentially coming in as well. Retail being a vertical to be supported, but I think some of the numbers at this point are still looking a bit weak. So when I think about it from a capital recycling standpoint, it's not as clear. But I think what China has going for them would be light investor positioning, as you've mentioned as well. The underweight has closed a little, but it's still an underweight. And valuations do remain attractive more broadly. So I think that does work in the market's favor, hopefully into next year.
So if that rally is looking quite concentrated and you don't necessarily see any sort of broadening next year, which names or areas or opportunities are you most interested in?
Sure. I would say that some of the winners that we've seen this year, for example, within the China tech giants, that remains to be a trade that I'm continually constructive on. We've seen things move within some of the tech names from talks of tech innovation to monetization as well. So there's still a bit of runway within that area. I do see some of the industrials continuing into next year, though we will some of the industrials rally continuing into next next year. Some of that has gone from a cyclical rally to more of perhaps exposure to the DC side. So that's an added leg that could give them a bit more runway as well. On the consumer end, as I sort of touched on earlier, it's been a bit of a laggard this year, and we've seen that through some of the autos names, some of the staples as well. I am thinking, can we bottom fish a bit there? But I am also looking for some execution or some of the numbers to turn a bit better going into the start of next year. So hopefully, if both of that lines up, that could be a good opportunity set for China next year.
Christina, thank you so much for that, and have a great new year. It was great speaking with you this year, and let's do it again, of course, early in 2026. Christina Woon, their portfolio manager at Eastspring Investments. Just maybe notice the graphic that came up on your screens right now. Just an iteration, if you will, on the weaker dollar story. In this form is the onshore Chinese currency inching closer to the 705 handle. The other thing we're tracking too is this is a two-day look at the equity at the 8 shares of China Vanke and that rally we had yesterday. We are opening lower though, going into the session today. Okay, are we doing this again? Okay, why not? Anyway, what are we doing now? 706.05. Okay, we're going back to Vanke, I was told. All right, let's have a look there. So there was a meeting, and the meeting was you had options on the table. 2 of the options, I understand, were for better terms, but they still have yet to decide and vote on which of the options and whether or not, once they do vote on the options, we get past the threshold, whether or not Vanke then, I think, approves what was voted for. If that didn't make sense to you, Trista Shinyi-Luo is here with us to help make sense of that. Did I get that correctly? Or okay. Why don't you tell us what happened?
So during yesterday's meeting, it was over like roughly 30 minutes meeting, and bondholders were represented with 3 proposals. The first one is Vanke's original proposal, trying to delay the yuan note payment for 12 months without any from payment cash or also installments. And the other 2, as you mentioned earlier, offer more generous terms, like asking them to pay interest on time and also for some credit enhancement. And right now they have until Friday to vote for. But Vanke's representative did reach out to some creditors on Tuesday, saying that maybe we can extend the grace period for a bit, and then we can have a revised proposal. So everything is still fluid right now. So we are watching closely on how everything goes.
Not the only one that's trying to, I guess, negotiate or reassure creditors, because China's aviation giants unit as well is in this, I'm not going to say same situation, but they're in that same situation. Okay, I did. All right, I said it. What can you tell us?
Similar boat of trying to meet its obligations.
That's exactly
financial obligations.
All right, Trista, yes.
Yeah, so they reached out to bondholder earlier this week, trying to reassure that they will pay their bonds like fully and timely, right? Because I think its local notes plunge a lot, to be sure. Earlier, because I think investors are increasingly worried about this company's financial health and also whether they can get more support from the government side. Because of everything happened on Vanke, it's a bit unexpected for the investors. So right now, investors are raising concern over maybe some weaker state-backed firms. So this company is one of those.
Trista, thanks very much for joining us. That was our China credit reporter, Trista Shinyi-Luo, joining us there. And let's also take a look at what's happening with Chinese stocks this morning so far. We're about 8 minutes into trade, but we have been seeing quite a big rally recently in the small caps index. Yep. And UBS is among those saying that this is actually looking to extend, and that's because investors are seeking shares that aren't actually available right now via the Hong Kong Stock Connect. So let's get more of that Asia Stocks reporter, Jeannie Yu, who's with us. So, Jeannie, you actually spoke to UBS about this phenomenon, essentially, that we're seing.
Yeah, it's actually kind of surprising to me as well, because based on the fact that Stock Connect actually cover more than 90% of the market cap, of the whole Asian market, and also there are so many stocks that have already been included in the Stock Connect. But when we talk to traders at UBS, they did say that there has been a very clear trend that investors, they're seeking access to those companies that's not available on the Connect, and they have been flocking to use the QFII quota, which give them less restrictions in terms of what they can buy. So basically, our data actually found that more than 1,200 companies, they're still not included in those Connect, and those shares have actually delivered a much higher return than the benchmark CSI 300. They've returned more than 30% so far this year. So I think that's one of the reasons, given the China market boom this year, a lot of investors, they're trying to, seek other ways to boost their portfolio return. So that's why they've been using more QFII.
Is this a sign that the winds are changing in favor of A shares broadly? And I guess a more broader rally beyond that, because you mentioned, right, CSI 300, CSI 1000, the latter has done better than the former.
Yeah, it looks like this is like based on the chats I had recently. It does like investors, they're getting more bullish for the onshore stocks, especially recently there has been some concerns over the liquidity issues, for Hong Kong, and also some people they're talking about, for A-share companies, they're actually they're having they're more like less correlation with the external market, so which give investors a very good reason to increase, when their uncertainty is actually increased, and then they need some diversification in their portfolio.
Thank you. Jeannie Yu there, our Asia Stocks reporter. You can check out her piece on the terminal. It's also on the internet. Okay, we're coming off highs across some of these markets. With a look at equity markets right now, we'll have plenty more ahead. This is Bloomberg.
Mexican lawmakers have given final approval for new tariffs on Asian imports, broadly aligning with U.S. efforts to tighten trade barriers against China. Let's get more with our economy and government reporter, Gonzalo Soto, who joins us from Mexico City. So this has just been approved in the last 30 minutes or so, but what exactly does it change, and what does it mean essentially as well?
Yeah, well, less than an hour ago, the Mexican Senate approved a new tariff bill that includes new levies for over 1,400 different products, mainly from Asian countries, but particularly from China. This, of course, means a realignment in Mexico's trade policy, trying to be more in line or in touch with Washington's trade policy. In the past few years, Mexico in the past has been very proud of inking different trade deals with several nations across the globe, but now it's trying to protect its national industry from Asian countries in particular. And I mean, this is an unprecedented bill in terms of the size of and what it means also to this realignment with the United States.
Yeah, that's a good point. It's a decision that wasn't made purely in a vacuum. Can you help us understand then what the broader consequences are from this bill?
Sure. I mean, this bill was presented back in September along with Mexico's 2026 budget, but after heavy lobbying from Asian countries and companies here in Mexico, it was delayed several months. And what this means is that there will be more restrictions for importers that bring into Mexico products from China in particular, but also Vietnam, Korea, other Asian nations that, according to the Mexican officials, have been hurting Mexican national production. But again, what this does is put Mexico in line with what Washington has been doing in the past few months, or at least during the Trump administration. And this comes just months before Mexico, Canada, and the United States have to sit down and revise the USMCA trade deal, a trade deal that, of course, Donald Trump has derided in the past. But the three countries will have to sit down next summer and talk about it. And this, according to several officials, will help ease those negotiations, or at least that's the intent. Also, the Ministry of Economy will get extraordinary new powers to move around those tariffs, to change them without having to undergo the legislative process to do so. So that is also an important change facing this renegotiation or this revision of the USMCA trade deal.
I mean, I can see that it obviously helps with the relations with the US and with Canada, but there are a lot of Asian companies that we're seeing that are going to Mexico to establish their North American manufacturing. So what is the likely blowback going to be, and also from China in particular?
Yes, actually, that is one of the reasons that this tariff bill took so long to pass in Congress, not only because of heavy lobbying from Asian companies, but also because people within the ruling Morena party were very skeptical of going into this type of trade war or involving Mexico in this tariff war with Asian countries, particularly because a lot of industries here in Mexico depend heavily on inputs from Asia, particularly China. I mean, Mexico, it has several differences with the rest of Latin America. Mexico, of course, is United States' #1 trade partner and doesn't rely as much with China for its imports. Nevertheless, several industries, particularly car makers or toys, home appliances, rely heavily on those inputs. So there will be some sort of backlash, although Mexican officials say there won't be a heavy impact, and most of the tariffs that have been implemented or the products that will be levied now or will be hit with by these new levies can be easily replaced by national production.
Gonzalo, thanks very much for joining us this evening. Your end, but that was our Mexico economy and government reporter there, Gonzalo Soto. And taking a look as we go into break here, we're 20 minutes into trade. Actually, we're seeing Chinese equities moving to the upside slightly. We are seeing volumes that aren't looking too heavy, though, right now. More ahead. This is Bloomberg. Mizuho Financial Group CEO says he's optimistic that momentum in investment banking will continue both at home and in the US, where Japan's third largest lender has been expanding. We spoke exclusively to Masahiro Kihara and began by asking about the impact of today's Fed rate cut.
It will have a positive effect on our business. The momentum will continue probably, and that's good for us. Yeah.
When it comes to the economic outlook for the U.S., do you expect the Fed to do more, given what you talk about those challenges?
Well, I think that's what we expect. I'm not maybe 2 or 3. Yeah.
In 2026.
Yeah.
You are already seeing the slowdown in the U.S. economy.
Well, if I talk with my people, what's happening in the real world, it looks like a little bit of slowdown is happening. Yeah. Although it's not still on the figures yet. But I think that's the reality, yeah.
But when it comes to those rate cuts, as you mentioned, it's still very positive for your business.
Oh, of course, it's very positive for us.
Where is growth for you in America?
So we have been building out our investment banking business to a full scale. 2 years ago, we bought M&A boutique from Green Hill. We finished the integration, and that by using our Mizuho platform and Green Hill platform, we're now able to pursue large-scale M&A deals, get the full value chain starting from M&A. For example, recently we did a big deal for Skechers, where Skechers was acquired by 3G Capital. In the old days, we never thought about that. Right now, we can do that kind of deals. Also, cross-border deals, Japan, U.S., that's expanding in our platform too. So U.S. is becoming a catalyst for our growth, actually.
Are you seeing a lot of competition from other domestic rivals?
Not really in this U.S. investment banking, I think. I think our strategy is to get all the capabilities that we want inside our bank, actually. Mitsubishi, SMBC is a little bit different, the strategy is. So not seeing a lot, bro. and rather seeing more competitions from European peers, or we're not going to be the 5 peers like the U.S. banks, but rather competition is from the European banks probably. And from a global perspective, our CIB league table, we were 13th last year.
Right.
This year we ratchet up to 11th actually.
Yeah, you continue advancing in that market. And you mentioned the U.S.-Japan cross-border deals as well. There's a lot of activity here.
Yes, there is.
Give us some of your outlook for 2026.
So I guess, I think everything starting from the corporate governance reform that has been executed by the Tokyo Stock Exchange, and that is still continuing, I think. And people, and the mindset of the CEOs has changed, that they need to improve their returns, ROEs, they need to invest. And we have been very, very strong in the large cap sector. And we have been able to capture corporate actions based on such momentum change. Also, what's interesting is that momentum change is spreading out into the mid caps too. Let's say 50 billion to 100 billion market cap. And we added on CIB capability in the mid cap sector. And what happened is that in 3 years, the revenue, the CAGR was somewhere around 60%. So I think the economy is trying to revive. The corporates are starting to make sure that they want to, starting to improve their return. And then we have a new prime minister who is eager to, grow the economy. So I think overall, Japan will be very, very interesting.
Okay, that was the Mizuho Financial boss, Masahiro Kihara, there with Sherry. Over in Tokyo, they talked about the Fed story. The Treasury story is right here. We're looking at a further rally across this, albeit, of course, very, very small. Due to spread there, and again, a steepening of the curve. Right, very quickly, EMFX, weak dollar coming up on your screens. We have a Philippine central bank decision later today. They're expected to cut. And, of course, coming up, we're talking about KraneShares. KWEB, heard about that? Probably have. They're listing in Hong Kong today. This is Bloomberg.
That strong rally means that it is definitely a key risk that we have to watch, even out here in Asia.
I think you could see some more rate cuts in the back part of next year, because what you'll likely see is the first part, you might elevate, inflation should still be a little bit elevated. You're going to see that cyclical pickup. In the back part of next year, you might start to see the economy cool down a little bit, and then inflation is likely to slow back down.
Certainly there was scope to get greater dissents from a hawkish direction than what we got. I think 4 regional Fed presidents, potentially Governor Barr, was also leaning against this cut.
The one thing he had left to say was policies at neutral. And he got very close to saying that. He said we're within the plausible range of estimates of neutral, but then when he gave his own opinion, he said we're probably at the higher end of that range. So I think he's still left the door open for January.
If productivity growth is driving gains in overall economic growth, it means we can actually have higher break-evens on the Fed funds rate, because the economy can grow more rapidly without having to lower rates.
Just some of the many guests we've had here on Bloomberg Television reacting and giving their first take on the Fed decision. They cut interest rate for a third time. There's, of course, the nuance there of silent dissenters. You had 3 dissenters that were on record, and of course, but you have many others who expressed it through other channels, like the dots.
Yeah, exactly.
That's a good thing, too.
Yeah, I mean, it was 2 policymakers from Kansas and then also Chicago, and then also, of course, the governor, Stephen Myron, who voted against, and that was on the actual voting committee. But then, yeah, there were a lot more, and it really does make that task for Jay Powell very difficult, but also the successor to Jay Powell as well.
It is, yeah. How does he deal with the divisions within the Fed? And when you look at the dissenters outside, of course, of Mr. Myron, really, they weren't as convinced yet over the case to cut, not just now, but into the future. Although you could make an equally strong case to cut by 4 times, which is what our folks at Bloomberg Economics actually thinks when you look mainly at the labor market and how they extrapolate that weakness into next year. So, I mean, we could be anywhere by this time next year. Dot Plot has 1, Fed Fund Futures has 2. The first of the 2 start in, I think it's June, July. And then that gets us into the rest of the year. Citi, I think, just to recall, Joanna Chua, the House view out of Citi is 3 cuts. This one and 2 in the first quarter. 2 more, right?
Yeah.
Okay. And I guess on that note, plus you have the stronger growth outlook that they've outlined, which is really good for equity markets, with the exception, I think you have to strip out the Oracle effect in some markets. But if we didn't have the Oracle effect, we'd perhaps be looking at more green on your screens. But that is to say, of course, we are seeing a rally in the Asia Pacific and risk assets here. Oil's another big story to track. We are continuing to see some strength there. There's the story there across the oil tanker in Venezuela that's picked up. I think second or third day we are seeing some upside pressure on energy prices, and the opposite on the currency markets, which is a weaker dollar. Asian FX stronger, Chinese currency stronger. When you look at the onshore rates, there we go. Right at about 706 right now, which should be the strongest level. They're going back to maybe late 3Q 2024, early 4Q 2024.
Yeah, we've of course seen the dollar moving lower off that with that Fed rate cut. But we can get more from Jay Powell, of course, in the press conference. Here are some of the big highlights.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. Available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months. So I don't think that a rate hike is anybody's base case at this point.
Let's bring in Bloomberg and live strategist Mark Cranfield joining us this morning from Singapore. And Mark, how do you read the Fed decision, and particularly as we've been discussing, just the amount of dissent that we're seeing tracking higher? How does that complicate the path, do you think, for stocks moving forward?
In the near term, not too much, really. I mean, investors and traders have latched on. If you notice in his comments there, reserve management purchases, everybody has jumped on that, especially foreign exchange traders. That is effectively QE light. That is the Fed going back to building up their balance sheet again. After a long time of reducing their balance sheet, they are going to start buying treasury bills again and boost their balance sheet. That's massive liquidity going back into US markets that will translate across the world. The clearest way for macro traders to do that is to sell the US dollar. You're seeing that happening. The US dollar is weak. We're probably going to talk about the yuan in a minute. That's one of them, but the euro had a very good move overnight as well. So that's one theme. Steeper curve in US treasuries. That's going to complicate the outlook for the market there. The short end is definitely going to be pushed down, but the yields are going to be held down by the fact that the Fed is buying so consistently. And yet, as some of the people in the earlier comments were saying, there's question marks over the path for inflation. That means the curve is probably going to steepen as we go into next year. The outlook for whether the Fed can or cannot cut more frequently next year, a lot of that will depend on who the next Fed chairman will be. Then there's the issues, how it relates to other central banks. Some central banks in G10 are starting to move towards a more tightening path. European central banks sounding a little bit more hawkish. They meet next week. RBA this week clearly starting to move that way. Canada and maybe even the Bank of England, they might lower rates, but they might not be a dovish cut as well. Things are changing within the G10 space. There's going to be a lot more friction. Plenty for macro traders to do in 2026.
Mark, I was looking at the Securities Times in China this morning, and there's a report there that talks about the sudden surge in hedging activity among corporates because the yuan, to your point, has been suddenly very, very strong. And overseas, and if you have overseas operations, you understand why they're doing that. What do you make of today's fix? Is that in some ways an endorsement from the PBOC of the dollar weakness? This is a big green light, effectively, for the yuan to rally further.
Oh, very much so, because if you look at the way the fixing came in, although the traders' estimates was a bit high, although the actual fixing was above the traders' estimate, the most important reading for the market's point of view is that the actual dollar-yuan rate was set at the lowest so far this year. In fact, going back even to 2024. So clearly, the PBOC is telling the market, look, we're willing to set the exchange rate on a lower path. We expect you to follow, not necessarily in a hurry, but at a gradual pace. It still very much looks as though the PBOC is ready to allow dollar yuan to go below 7, maybe even back to the mid-6 level, 6.5 or so, as we get into next year. There's another story out on Bloomberg today saying that the trade balance this year for China has been extremely good, around $1 trillion or so. It will probably get even bigger in 2026. When you take that into account, there's plenty of room for the yuan to shift to a higher trading range. On top of that, if you look at the significant change in the way that traders are positioning, at the beginning of this year, they were using the forwards and the options market to take bearish positions on the yuan. They were using that as kind of a hedging tool. That has completely changed. They're now using the forward market to enhance their bullish positions on the yuan. So clearly, there's a dynamic shift in terms of thinking about the yuan's path, which is helped by the central bank. And then you've got the external picture, the fact that the Fed is helping to lower the price of the US dollar by doing this reserve management purchase as well.
Mark, thank you. Mark Cranfield, setting us up quite nicely in terms of maybe risk or risk appetites going into next year. Raj Singh is with us here on Sept, multi-asset portfolio manager at Principal Asset Management. Raj, very nice to see you. Is this a big green light to take on more risk?
I would say definitely it's risk positive, especially compared to where the market was expecting. So market was looking for a hawkish cut from the Fed, but we got here the reading from SCP, for me, if I can summarize in one line, is productivity-driven Goldilocks, basically. That's what the SCPs are telling us. So as per Fed, we are in a good economic environment. Growth is going up, inflation coming down, and probably your labor market is softening, but not too much. So good for risk environment. The next thing, what we saw in last month or so was this big pressure in the funding markets. And market was looking probably Fed will do something in January, but there was a positive surprise of 40 billion buying for the reserve management, so which means the Fed balance sheet will go up and will go up with the nominal GDP of US, which we are still looking for somewhere around 4 to 5% growth next year. So I think on the net, it is really positive. The other observation I would highlight though is that a lot of these projections are based upon AI. So the AI become linchpin not only for the market but also to direct to a certain extent the Fed policy.
Can you delve into that relationship a bit more? How exactly that's being underpinned by AI and what happens from here essentially too?
Yeah, so basically when we look at the SCPs, what is happening, your growth is higher. So it's driven by the AI capex to a large extent. And then your inflation is coming off based upon the SCPs because of the productivity gains. So what do you do basically for the same amount of labor? Either you're producing more goods or basically you are reducing your labor and producing same amount of goods. So in that way, I think the AI is going to do productivity gain as per Fed, and probably it's going to stay with us for a few years to come. So it's very similar to what we saw back in 1990s, where Fed was just going for this productivity-driven growth. So I think that's AI thing is very important, not only for the markets. I think Fed is one part of it. That definitely the market is also driven by what is going to happen to the AI theme overall.
Why then, given that growth picture, do you see the Fed needing to still cut interest rates?
Yeah, so I think when you read the Fed here, it was definitely an insurance cut, and I would say kudos to Fed here. Like they have done a soft landing from 10% inflation levels to now where we are sitting here. So definitely when we look at the data, of course there is a vacuum in the data, the labor market is softening here, and look at the jobs, like your quit rate is so low. So basically it means you can enter this phase where you have this jobless GDP expansion in U.S. and the economy can be very fragile. So I think this insurance cut makes sense, especially given that the funding for the government is until end of Jan. So basically we may be in the similar situation in next 2 months.
What happens then for Asia stocks next year, and which benchmarks do you see being the biggest performers, do you think? Do you still see that the ones that are tied to AI specifically, Taiwan, Korea, Japan as well?
Yeah. So I think in Asia, probably we are looking for this bubble of AI, the Taiwan, Korea. I mean, those are good spots to be because ultimately the capex is going to be there, that the tax credit in U.S. and the tax bill incentivize companies to bring that capex earlier. So I think that's there. But I would say apart from that, what we are looking India. It's a great diversifier for your portfolios whenever there's a pause. So there will be apps and flows for the AI trade. And whenever those are happening, I think probably the money will flow to India. Apart from that, India has domestic story in it. I think GST reforms we saw, labor codes we saw, and still the domestic liquidity is ample and RBI is supportive. So I think it provides a good diversification to that AI trade in Asia. So that's where we are looking for and in position for 2026.
And just between exposure to equities and exposure to fixed income, the Fed is cutting, but Mark Cranfield, our colleague, just pointing out, others are starting to plant the seeds of interest rate hikes. How do you feel about fixed income returns next year? Up in duration, or do I reduce exposure to fixed income substantially?
Yeah, so that's a great point. What do you see globally that the easing expectations are coming down, and it was also for the Fed. I mean, before this meeting, just 3 weeks back, we were looking for 3 cuts for 2026. Now we are setting 2 cuts. So that easing expectation from the global central banks is definitely coming down. But at the same time, your labor market. We look at the Aussie report this morning. What happened? So the labor market globally, it seems a little bit fragile because of the AI. It's impacting a lot of industries. So you don't know where you will sit on this. And then I think the curve has steepened a lot. And a lot of fiscal angst is priced in the long end. So from our perspective, you want to ride the carry at the short end. You still want to clip that coupon, but you need to go for the duration at the longer end of the curve. And when you look at the curve positioning right now, I think the U.S. has done pretty well. It has outperformed most of the curves. And what this Fed cuts give, which is not probably appreciated in the market, is it gives a little bit more breathing room from a fiscal side for U.S. as well. It's like U.S. is sitting on 21% of the bills, and the bill supply is going to go up. So probably we are looking for longer duration here. I think either through the Fed cut, labor market slowdown, or if the AI trade is not working, I think it's a great hedge in the portfolio. So we want to be there. But not only the fixed income, we want to express this view in equity side as well through the financials. Globally, I think the financials make sense given the curve is steepening, and if your easing expectations coming down, that's the place you want to be probably.
Yeah, I guess it's that question. Do you see any sort of jitters that come back in with the new Fed chair coming through, and whether the traders essentially trust that pick as well, and the responsibility as well around the easing part? But Raj, thanks very much for joining us this morning. That was Raj Singh there, a multi-asset portfolio manager at Principal Asset Management. Still ahead, we count the cost of, well, it's a diplomatic tussle dispute between China and Japan still ongoing, and tensions continuing to weigh on retailers as well. We'll talk more about that next. This is Bloomberg.
I have stated that Japan's national policy has not changed at all. Their response is that this alone is insufficient. But as for what should be done about it, I'd rather not get into the content further. We've been having various discussions. We've been mentioning our thinking over how to overcome this situation. Honestly, there's nothing I can discuss at this point.
That was Tetsuo Sato there, the head of the former Japanese ruling party, or coalition partner, Komeito. And he says Japan and China's diplomatic dispute shows no sign of immediate off-ramp. That's despite his party holding talks with Beijing officials. Tensions have spiked between the two countries over the past several weeks, and that's after remarks, of course, on Taiwan by Prime Minister Shinzo Takaichi. So those tensions we've seen putting a lot of pressure on Japanese retail stocks, tourist spending as well as under threat. I mean, it's really important to just recognize the significance of Chinese spending in the Japanese market, because it has been the major contributor, actually accounting for about a third of spending by foreign visitors to Japan last quarter. So a lot. But let's get more of that equities reporter Alice French, who joins us out of Tokyo. So Alice, given you've just got so many flight cancellations and continuing to see that pullback, how is this actually having an impact, and when do we really start to see it showing, perhaps when it comes to earnings?
Yeah, I think that's the big question, right? This spat, I think, has gone on for longer than perhaps some investors had originally thought. We're now kind of a month in, and it doesn't really seem to be showing any signs of sort of slowing down. Like you say, it's really the tourist spending here that people are worried about. We know that Chinese tourists do make up around 28% of tourist spending, and that's a big chunk, right? And especially in the kind of luxury space. So things like department stores, Shiseido, the cosmetics firm, is also very popular with Chinese visitors, and so those stocks have really suffered, and I mean they really plunged sort of the day after things ramped up in mid-November, and they've kind of just extended those declines over the past few weeks. And we've even had some brokerages kind of re-rating some of these names as we go into 2026 on the worries that, you know, if that spending and those tourist visits do kind of go down, that it will really start hitting earnings and sales. Now, of course, you know, we have seen record numbers of tourists coming into Japan this year from all across the globe. Really, it's not just China. And so, you know, we've got those American tourists, the European tourists coming here on the weak yen. They could cushion some of that blow. But, you know, we know that Chinese tourists, as you say, make up a big chunk of spending. It is a risk. And I think in some ways it's a Japan-specific risk that some investors are getting a bit nervous about as we go into the new year.
Yeah, I mean, we're just showing it on the screens. 8 million so far in tourist flow. I just had a look at, you know, yuan yen, and that's at 22. Effectively, let's call it highest in so the incentive is really there to travel. Could this dispute, Alice, really threaten that overall trend that we've seen?
I mean, I do think there's a risk that it could. You know, we've seen some figures coming out that flights from China to Japan might have been cut by almost a half already this month. Now, that's obviously pretty big. We've been hearing that China has been asking airlines to cut some flights through as long as March. So this could really extend. And of course, any escalation, any kind of ramping up in tensions is going to be bad for these kind of China vulnerable names. Now, I mentioned Shiseido there, Fast Retailing that runs Uniqlo is another option. Now, it's not just tourist spending, okay? A lot of these companies also rely on revenue from China. They sell to Chinese consumers in the mainland. If tensions ramp up, could that even start weighing on kind of, you know, consumer sentiment over there? We know that in the past, for example, Fast Retailing has been hit by boycotts even from Chinese consumers. Now, we haven't quite got to that level yet in this case, but, you know, as things keep simmering, it's not completely out of the question. And I do think the risk is real. Having said that, you know, there are lots of other reasons to kind of be buying into those Japan retail names at the moment. We do have a pickup in kind of, you know, domestic consumption. Of course, inflation is also on the horizon there, so there's perhaps a need for caution too. But I think, you know, it's not that these names are going to fall completely out of favor, but the downside risk has definitely ramped up, and it is something to keep an eye on for sure.
We had an interview recently with Taiwan's foreign minister, and he said that he expects that the effects of this spat to last for the next year. I mean, how does this actually have a bearing then on the longer term ramifications for Japanese equities, or does it have a longer term impact?
Yeah, I mean, it's all going to be on the timing, right? And as you say, it's going to depend how long this goes on for. And I think once we start getting in those tourist numbers kind of over the next couple of months, and we actually start to see quantitatively how many few Chinese visitors we're getting, I think it'll be easier for investors to make that call. But, you know, as I mentioned, there are lots of other kind of dynamics going on in the Japanese market. Of course, we're just, you know, a week and a bit away from the BOJ decision next week. Of course, we had the Fed overnight. People expecting a hike there from the BOJ, and that will probably boost things like financials. We've of course got all of this fiscal spending and this kind of stimulative spending from new Prime Minister Takaichi as well, which is again fueling those kind of consumer names here domestically. Of course, we've got things like corporate governance continuing in the background, those tailwinds, M&A. So I think, you know, there's still lots of reasons to be cautiously optimistic about Japan as we go into the new year, but the China risk is for sure one to watch, and not to mention other geopolitical things like tariffs, etc. So it's going to keep investors busy for sure.
Alice, fantastic. Thank you. Alice French, there, our equities reporter, on the latest on this front. A quick glance at equity markets, and we'll see you guys in a bit. Welcome back. Right, let's have a look at Keppel. I think this is the REIT and Hong Kong Land, which is listed over in Singapore. Keppel REIT is going to buy a 1/3 interest in Tower 3 of MBFC, which is the Marina Bay Financial Center tower there. 1.5 billion Singh is the price one for that. Speaking of property, just a glance at Chinese property names on your screens. A rally within the session yesterday on Vanke, for example. We're seeing it pull back today. Not to the extent we had yesterday, of course, but we are looking at declines across that market. It is, of course, does remain a very, very soft spot on the broader Chinese economic story. And just list a trading debut today. Jingdong Industrials has paired most of the early losses. We're still down 2.5%. We're down as much as 8% at one point. And speaking of another debut here today, ETF, you have KWEB listing here in the city today, and coming up is the COO of KraneShares to talk us through the listing here, what they got planned, of course, going into next year. So stay tuned for that interview and many others, including a wrap of the Japanese close as we head into the lunch break in Tokyo.
Japanese markets are just about to go into their lunch break this morning, and we are seeing them actually some downside pressure, and I think that really points to just the importance of Oracle for traders today, because actually the conditions were looking pretty right post that Fed decision, and you saw really moves to the upside, but then the Oracle numbers came out and really continued to pour concern around, or pour.
Well, I mean, the return on investment.
Yes, that's
right?
what I want to say.
Yeah.
Essentially, Oracle came out. They have a huge capex. They're not getting the ROI. Traders are concerned. They're also very concerned about the tie-up between Oracle and OpenAI specifically. You've seen that reflected in the share price. It's lost around 1/3 since its September peak. And so you see names like SoftBank, for instance, that are really dragging down the benchmark so far in Japan today.
That brings to mind, and just letting my producers know, I'll probably need a minute to get my thoughts out on this. So as you look at SoftBank down on 7%, right? So I think 2-3 weeks back at the New Economy Forum, and the reason I'm saying this is Mark Rowan was on stage out of Apollo. And I wrote about it, in fact, on the Hong Kong newsletter, which is coming out today. That's the plug. But so he said, when you look at the market structure these days, public markets, bank lending, and private markets, the projects that these AI infrastructure, for example, that they're building out, these are extremely longer-term projects. So the return, fine, we're not going to get them in the next, let's call it even few quarters, right? Bank lending, borrow short, they're not really structured and designed to lend long. Equity markets, we know, are impatient with quarterly results. So that's really where private markets come in, because these are longer-term projects that need longer-term time horizons from patient investors. And I guess that just is my way of crowbarring in my entry today to the Hong Kong newsletter, speaking about why more companies are now able to remain private, because they're able to raise the amount of debt and equity in private markets that would otherwise have only been available, to Mark Rowan's point, only as an IPO way back. But now you can stay private. Look at SpaceX, for example. But although, of course,
they're looking to list.
Yes, okay.
I understand what you're saying. I mean, we've seen a real explosion of private credit, and that certainly looks to be sustained. But taking a look at some of these other moves in the session today?
Yes, so we're looking at Ryohin Keikaku. If you're not familiar with that, that is, of course, Muji. Overseas sales were doing well, the point Alice French was making. Overall, though, we have paired most of the gains, right? On the benchmark, we're now just up 1/10 of 1%. U.S. futures are now down about 0.5%, so that didn't last long, did it?
Well, I think it's that tech story. You can see tech gauge is dragging it down.
And I guess it doesn't help that you have really large caps there and very heavy weightings in these benchmarks. Anyway, that's just to say that takes us into the other top story we're tracking today. We talked about Jingdong Industrials and that IPO. There's the other one, of course, that is debuting here today in Hong Kong. KWEB, if that moniker sounds familiar, because it probably is. KWEB in the U.S. KWEB now lists in Hong Kong. And you have ETF provider KraneShares, of course, providing this product tracking Chinese internet names here in Hong Kong. It follows listings in London, also in Abu Dhabi, on top of course, the actual listing in New York. Joining us from New York, KraneShares COO Jonathan Shelon. Jonathan, good morning, sir, from the Asia Pacific. Thank you for joining us today. Momentous day. It's now available here, right around the corner from where we're sitting. Why list it here if I can buy it anyway where you are? That's my first question.
Sure. Annabelle, David, thank you for having me. Delighted to be here with you. We're delighted to be expanding our partnership with ICBC and launching KWEB in Hong Kong. This really completes the link, if you will. KWEB is already listed in New York and in London, and now we have really nearly continuous global access to KWEB around the globe, irrespective of region or time zone. And that's something that we've been wanting to accomplish for a long time, and here we are.
What's the rationale for Hong Kong specifically, aside from closing that loop in terms of access throughout the different time zones? But Hong Kong, of course, this is the market where a lot of these names are already listed. You can get direct access, and there's other similar products in the market as well.
Well, we think KWEB has been recognized as one of the most efficient and effective ways to gain access to China growth, as indicated by its status in the U.S. as the largest China-focused ETF in the U.S., and also by the flows that it's attracted this year. We've seen about $3 billion of net new flows across our U.S. and London-based versions. And, we think by giving this new access in Hong Kong, it potentially opens it up, not just today, but sometime down the road for ETF Connect. And that gives southbound money the ability to potentially purchase KWEB from Hong Kong, over some period of time. It's not there yet, but it can get there over time.
Jonathan, talk to us about the partnership with ICBC. How do they come in here?
Absolutely. So we've done other things, and ICBC has been a sub-advisor on some of the funds that we manage in Europe, and so now we thought we would expand on that and have a fund together in Hong Kong. So we're really excited about what we're doing. We're continuing to do more with them, and we think it's really exciting because we can work together here, leveraging the great work and 12-year history we have in managing KWEB, but at the same time leveraging their brand knowledge and expertise in the region.
Do you have a target on inflows and what you're expecting there?
Well, it's interesting, right? We've seen a lot of demand this year for KWEB, particularly out of EMEA and Latin America. So a large part of that $3 billion I talked about came from that region. Now, mind you, we started with a fairly significant base. KWEB now collectively is over $10 billion, but it was still very sizable at the beginning of the year. But we have high ambitions. I'm going to resist in giving you a specific number, but I'd be really disappointed if we didn't make significant inroads based on this launch and the timing, and also our excitement and enthusiasm for the performance potential of the names inside of the KWEB basket. There are about 30 companies, and even though it's called China Internet and E-commerce, it's a little bit of a misnomer because so many of those China Internet names are really AI companies, if you think about it.
Jonathan, I understand you can't give a specific number or a specific target. What about a range then? Could you share that? Or whether you think it's going to be comparable then to the inflows you've already seen in EMEA, for instance?
I think they'll be smaller just because this is a new strategy. But, we're very enthusiastic. We think that it can be sizable and reach scale very quickly. And we have high expectations, say 12 months out, in large part because we think some of the challenging years that we've seen in performance, keep in mind that KWEB's prior high was back in 2021. We're starting to see a good move in terms of geopolitical risk, but also the earnings and the valuations of these companies. If you think about KWEB from a valuation standpoint, we have PEs of 18 times, whereas U.S. technology is trading at 33 times. So global investors are starting to realize that there's a lot of value to be had here. And if you consider that some of our top names like Alibaba and Tencent, had revenue growth of 15% in the third quarter, this is really a unique period of time to invest in this segment. Not just, we would never suggest somebody putting all their money in a strategy like KWEB, but as a diversifier to what many hold today, which is a large overweight to U.S. technology.
Yeah, well, if only a call-and call strategy was available. Oh, you guys have that. There's the flag, Jonathan. Well,
thank you.
Just to also ask you, since you brought up the appetite and demand for exposure to Chinese tech specifically, and
yes,
and I wonder. So we know on the valuation discrepancy, right? Let's call it they're trading at half what you have in the U.S.
That's
I wonder
right.
how that message is resonating with U.S.-based investors compared to how it resonates here in the Asia Pacific.
Mm-hmm.
Are you seeing the same amount of appetite and gusto for exposure to Chinese equities there?
It's definitely moving west. We still know that a significant portion of institutional investors, U.S.-based institutional investors, are underweight China. And they're slowly bridging that gap because being underweight China over the last few years was a way of generating alpha. In a year like this year, it's a way of underperforming. So investors are being forced to revisit their China underweights and add slowly. And KWEB is a beneficiary of that because it's one of the better performing China strategies. It's also very large, has significant volumes and tradability. So we're seeing that gap narrow, but the U.S. investor is not yet at a point where they are either neutrally weighted to China or overweight. That's actually the opportunity. Investors are watching the performance, they're watching the impact and the opportunity cost of not being fully invested, and they're starting to make those types of moves. So we expect the trends that we saw starting in Asia, moving to Europe and Latin America, we expect those to appear in the U.S. here in 2026.
So can we talk about the pricing as well? Because how are you looking to price this? We know that Hong Kong ETFs can be more expensive than those that are listed in the US in particular. Mm-hmm. But how does your pricing compare to what you see from other ETFs in this market, for instance, from Sept or iShares?
Mm-hmm. Well, what we've done here is created a consistent experience. We've priced KWEB in Hong Kong consistently with how it's priced in the U.S. So our management fee is 68 basis points. We think this is very competitive and compelling given the value we've produced.
Jonathan, final question for you. Apart from this, give us a preview. What's cooking in your kitchen for next year? What's big for you guys?
Well, look, we continue to focus on innovation. Obviously, KWEB is part of our franchise strategy, but we're doing a lot in the AI space. So KWEB's an example of having exposure to AI within a China-focused portfolio. But we're also, we've launched strategies in the AI space that combine public and private investments, for example, in an ETF. And we've also launched the first US ETF focused on humanoid and embodied AI. And we've launched that in London as well. And that's called KWEB. So we think that, whether you're gaining various AI exposures through KWEB or through ETFs that combine public and private investments, or even, going a step further to embodied AI, we think that these are really important trends to capitalize on, and not just short-term trends, but really mega trends that'll play out over a period of 10 to 20 years.
Jonathan, thank you so much for taking the time, and we hope to see you if you're in town next time here in the region. Jonathan Shelon there, the COO at KraneShares. Now, just speaking of AI, it's a top market theme, of course. Today we talked at length already about the concerns around high capex, where they're going to get that money, where they're going to realize that return, and certainly that brings us into, again, the Oracle angle to what's going on.
Yeah, well, we had the numbers after the bell and we saw such a big drop in the share price, more than 11% down. And I think going to that question or concern around CapEx, it's quite extraordinary when you go through the numbers of what Oracle posted, because in the latest reporting period, for instance, you saw CapEx actually increasing to $12 billion. And in the 3 months prior, it was at 8.5. So 8.5 to 12 in just a space of a few months. And then in addition to that, analysts have been expecting it to trend down to 8.25. So you can see that is going to have a bearing, especially when that ROI isn't really translating. And you're making that point that a lot of this infrastructure is a long-term play, and so you don't necessarily expect to see it in the short term. But at the same time, what we see, for instance, in cloud revenue and also in their infrastructure business revenue, undershot expectations slightly. So that's very much the dominant theme, I think. And as to your point earlier, we're saying that tech stocks or stocks generally in Asia would be doing a lot better today if it wasn't this Oracle story. And you see that specifically in Japan with SoftBank, for instance, and SoftBank's fortunes, really tied to what we see with Oracle and also OpenAI in the US and Project Stargate, for instance.
Yeah, well, we saw them in the Oval Office, right?
They're financing the project.
Yeah.
So and they also sold off their Nvidia holdings for it. Yeah. So it's they're very closely linked to it, but really concerns around Oracle's ambitious long-term growth guidance as well that came through in the numbers, and also just largely anchored to that contract with OpenAI once again. And of course, the story around OpenAI is that we're concerned that how competitive is their model against Gemini, for instance, others, and
what's the switching cost conversation?
Well,
around
I was
those
saying
things?
it's very low, and I think that's a big problem, is that the barriers to entry aren't really high enough for this, and it's becoming increasingly commoditized. And that presents a big hurdle, because I was speaking with someone just the other day who runs a business, and he said, I thought Gemini was doing better. I just downloaded all of the data from OpenAI or ChatGPT, and I switched across. And it was as easy as that, essentially.
If all you need is a Wi-Fi connection, there's probably an issue. Of course, it's more than that. I'm teasing. All right. We'll have plenty more ahead. Look at markets at this point in time. And to Belle's point, right, with the exception of the Oracle story, we would have been doing better. And I think this board underscores those two salient points. This is the China Show.
Right, we're seeing oil prices slightly firmer, and that's also after a Bloomberg scoop. We had some exclusive reporting around this. We were the first actually to report the interception and seizure of a sanctioned tanker off the coast of Venezuela. So a serious escalation of tensions between the US and Venezuela. But let's bring in our senior editor, Balazs Pens. And so, Balazs, give us more context here and exactly the impact of this or the meaning behind it.
Yeah, this has been since confirmed by the administration that they seized a very large vessel which carried about 2 million barrels of heavy crude from Venezuela. And this does indeed suggest a serious escalatory step in the U.S.'s pressure on Venezuela, on the Maduro regime. And it remains to be seen how Venezuela might respond to this. But one thing that this does is this is going to make it so much harder for Venezuela to export its crude even further. Venezuela has, of course, been under sanctions for a while, but they have been able to use these kind of marginal operators, this sort of gray fleet, dark fleet elements to export their crude. But if the U.S. will be watching so closely and seizing vessels, every single operator will think twice about carrying Venezuelan crude.
Yeah, I was going to actually ask you, because I'm looking at the OPEC function on the terminal. So Venezuela, as a piece of OPEC, 3.3% based on the data that we can extrapolate. Would this mean less oil? Can we make that distinction?
Well, that's really hard to say. But if Venezuela is unable to export its oil, that stands to reason that there would be less supply on the market. Right. Now, what other forces might be in play and how global demand might be affected by that. That's kind of hard to extrapolate at this point, but certainly there should be more of a squeeze on the general supply.
Yeah, more than otherwise. Fantastic. Thank you so much, Balazs Pens there, of course, our senior editor on our Bloomberg Scoop today, which is leading to higher oil prices going into the thick of Thursday across global markets. Plenty more ahead here on The China Show. This is Bloomberg. Right. Welcome back. Let's talk to you about this Bloomberg scoop we just learned about a few minutes back. So remember this ports deal a few months back? I'm guessing some of you forgot about it. Well, talks have been ongoing. And we have a Bloomberg scoop right that tells us maybe these talks are still ongoing, but for reasons not expected. Very complicated transaction. Joining us here on set, Manuel Baigori, of course, who's here to talk about the details of what we understand and the snags.
Exactly, David. It's a very complex deal touching on, very, very core important assets, strategic assets for obviously the companies, but also the different countries around the world, like 43 ports in different markets globally. So there is a web of complex issues, the geopolitics, the deal structure, the potential role that China may play in this as well. Remember that when the whole thing unfolded back in March, it caught a lot of people off guard, and their reactions weren't that great. Yes. This part of the world. So they've been trying to kind of assuage the concerns and trying to make it work for everybody. But it's very complex. As you said, the talks have been dragging for a long time, and there is a lot of uncertainty as to when and if this may actually come to fruition. Just to be clear, the talks are ongoing, and our reporting clearly shows that they're still trying to get it done. It's just that there is a lot of complexity and a lot of issues that they need to resolve.
And so, as you say in the piece, C.K. Hutchinson says it won't actually proceed without getting the green light from relevant authorities. But what do we know about maybe the consortium then, or the likely bidders? And are those people sticking around, or is that also shifting?
Yes, Annabelle, that's a very good point. Yes, the bidders, which include GIP, the infrastructure arm of BlackRock, as well as Teal, which is the ports business of MSC, which belongs to the Aponte family, a Swiss-Italian billionaire family, and then potentially also Costco, which is back to what China may do with this deal. So those three components are part of the bidding group, and they're still committed. So to your question, they are very committed. They still want to get the deal done, and so is Hutch, which is the seller. But again, they need to kind of negotiate, get comfortable with the deal structure. They need to also ensure that the governments all around the world where they have the ports are also okay with the deal, and
it's not easy.
Exactly. It's a big deal touching on multiple jurisdictions, very important strategic assets. So it's a lot of boxes that need to be ticked, and that takes time. It's just that it's been since March, right? There was a soft deadline back in July. They couldn't meet that. They extended that, and it remains to be seen when this may happen. Or it could fall apart. It's still a big question mark.
Well, what we know is it's complicated. Manuel, thank you so much. Fantastic. Manuel Baigori there on what's going on, or what isn't, really, given the complications here. Very quickly, we're going to go through very quickly Chinese movie stocks. Avatar 3, December 19. I haven't seen the first one. Pop Mart is up. LVMH is involved in a sense that the appointment of a former member of LVMH there. Shares are up ever so slightly. And we'll leave you with a look at the other top story today, which is the Oracle story and how that's showing up across these markets today. NASDAQ futures are feeling the pinch. And I can tell you in the last couple of minutes or so, we've seen a downdraft start to really come through across the Asian equity complex on the back of the story, down about 1%. That's it from us here on The China Show. We will see you all tomorrow. Insight with Azlinda Amin is just ahead.